What's going on, everybody? It's Matt, aka the Lumberjack Landlord. Super excited to be here with you for segment number 2. We are going to talk about a very recent event. In fact, just a couple of hours ago, our good friend Jerry Powell decided to just, I know I'm not going to call him Jerome. I will not. I refuse.
Just Jerry.
Yeah, just Jerry. My good buddy Jerry. So our fantastic Fed chair decided to take the stage today. Thankfully, if you were paying by the word, it didn't cost you a whole lot, because usually that's a whole lot of noise about nothing. But he actually said at the beginning of his speech, because I watched it live, I'm going to be clear, succinct, to the point, and direct. I was like, is this guy still a government?
Yeah. Does he know what those words mean?
I was willing to give him the benefit of the doubt. So basically, his take on it is that they're going to stay aggressive. Mike, what's that mean to you? Because I know what it meant to me.
Well, so let's step back, right?
Sure.
And let's step back to 2 Fed meetings. So there's going to be 3 meetings. So 2 meetings ago.
Yep.
Jerome Powell comes out, answers questions for an hour. The very last questions about real estate. At the end of it, he utters the word housing reset. I'm going to come after housing. Lots of people obviously took that to mean housing crash, prices. That's what people wanted to hear. Okay. You step forward to the next Fed meeting. Again, his meeting is rather hawkish. And then he comes out and says the stupid words of, I think we are at, basically break even, and basically saying we're almost done. Jackass. Whoops. And again, all around this, right, the stock market has basically been betting the Fed's going to pivot sooner rather than later. So I guarantee you the Fed was pissed off that the stock market took off. That's not what they wanted, right? They want asset prices to come in. So he goes to this meeting, Jackson Hole, which we don't have a Fed meeting. He just got a PCE reading this morning that was good, if not very good. That's on the back of CPI being good, PPI being good. Lots of people were expecting Jerome to come out and be kind of dovish, because again, he's been kind of dovish the last 2 meetings. And basically Powell didn't do that. He basically said, you're not hearing me. We remember the mistakes of the past. We won't stop early. If anything, we will go harder longer than you expect. We will err on the side of being too aggressive versus pausing early. So what does that all mean? That means that the Fed is raising rates higher and faster, and will and more importantly, stay there longer than the market expects. The market was pricing in a Fed cut Q1.
Yeah.
Cut, not pause, cut. That's off the table. Yep. So you're seeing all kinds of rates reprice. The 10-year note went over 3% last week. It was over 3.1. I haven't checked this morning. I assume it's up. And the rates are going up. So now what does it mean to us as investors? Well, the Fed funds rate's going up, which is going to take the 10-year up, which is going to take the mortgage rates up. My greatest fear is the housing crash in transactions is just getting started. Yep. I think we know what happens when 30-year money's at 6%. We've done it. It's not good. But what if 30-year goes to 7?
Yes.
How much lock-in do we have? How much buyer destruction do we have? We did, I think, 4.8. Could we be at 4.3, 4.1 total transactions? Absolutely. Real estate is in a depression. It's headed for a recession. If you're paid off of anything in housing, it's going to feel like a depression. So I expect transactions to go down. And then more importantly, counterintuitively, this is where I disagree with a lot of real estate channels. I actually think inventory is going to fall heading into the end of the year.
People pull stuff off because
they'll pull it off. They won't sell. The move up market's dead even more. The bigger the gap gets between a 3% and what would become a 7, more and more people are never going to list, which means they're never going to sell. Right? The move up buyer is so important to the real estate market because it's 2 transactions. It's a buy and a sell.
Yep, agreed.
The Fed broke housing. It's broken for years. And I think most people get emotional. They want a housing crash in prices. They don't understand how destructive
the pain
and how bad. a housing crash in transactions. I will admit to being annoyed that I called a housing crash, even put 30% on it, and it happened, and I'm not getting credit for it because everybody wants a price crash. And I'm like, dude, it's not coming. It's certainly not coming in 2022. I don't know. I don't care what the the guy in the mom's basement keeps saying. It's mathematically not happening, at least on a year-on-year basis in 2022. You want to talk 2023? We can at least have that discussion. But a housing crash is happening, and I think it's going to get worse. And it won't be good for the economy.
Dion, your thoughts?
Mike seems to care about people a lot more than I do. We are investors. The people watching this channel, you are an investor. We need to invest to protect ourselves. And the people who are really going to be greatly impacted by any kind of recession that's caused by a housing crash and transactions isn't the investor. It's going to be the person who has just their W-2 to rely on. And if you're thinking recession is coming, I don't want to be an investor because people might get laid off and not pay their rent. When you're laid off and can't pay your rent, if it's your only source of income, that's the person to be concerned about. So the people watching this content, I think, are going to be in a better position. I kind of have a different opinion on aggressive doesn't mean we're going to see increases. I think aggressive means we're going to see swings like we've been.
Mm-hmm.
We're seeing 75 basis point changes 2 in a row. The second one to where everybody went, yeah, we expected it. We already did one. But the first one was the largest change like that in decades. Mm-hmm. But we've been kind of mind wiped into, oh, that's normal.
Right.
So I don't think we'll see very many quarters or months that go, we're here next month, we're at the same point. Mm-hmm. Or we're 25 points up or 25 points down. I think we'll see 50 or 75 up or 50 or 75 points down.
Wow.
And I don't want to have the crystal ball and predict and think, I think rates are going to be 5 points higher, literally 500 basis points in a year, or 500 or back at zero in a year. I want to go, if rates are higher, here's my plan. Exactly. If rates are the same, here's my plan. If rates go down, here's my plan. All three of those plans are hunting for the great deal today.
Correct.
You're absolutely right. I mean, I'm so glad you said that. People don't really understand, but I mean this. I don't care what the cost of capital is.
Right.
It is one variable. One on my entire spreadsheet. 100%. It's one variable. Now, be clear, I only get 30-year fixed rate debt. I am not willing to gamble with a 5-year ARM, 7-year. Some of you are. I am not. I want to set it and forget it and be done. And oh, by the way, if rates fall, I will refi and get lower, but I'm not betting on. I will not bet that rates are better in 2 years. Some of you will. I will not make. I have studied the 70s enough to know that we could have a whole decade where rates are higher in 2029 than they are in 2022. I have no idea where this economy is going, but I can do a great deal today with today's cost of capital. So Dion, thank you very much.
Mike, real quick on that. So do you know what are so to get that 30-year fixed rate debt that you're talking about for you, an investor of more than 10 units or 10 buildings, what is that DSCR loan costing today?
Probably 7%. If you have the best of best credit and you put extra down, right, lower LTV, you could probably get a 6.5.
Okay. But we're talking normally 7%, and that's at a 20%,
25.
So 25% down, 7% debt. So I'm doing it at 5.25 for 7-year.
Oh, okay.
But amortized over, but a normal commercial deal, 25 years.
Okay.
But on a less expensive asset, about a $500,000 asset.
Sure.
So it's not like a $7 million asset where that number can really move.
Really move.
And I've even adjusted it and said, okay, let's just say rates are 7.5 or 8, right, for an investor in 5 years. Let's say that's the number when it starts to reset. Let's say it's 7.5 or 8, maybe even 9. Okay. And I've looked at it and said, okay, but I can get 7 right now for a 30-year fixed, or I can roll the dice a little bit. That's what I'm doing. I'm rolling the dice a little bit and saying 7-year adjustable rate debt on a smaller asset as part of a much larger portfolio that is almost all 30-year fixed.
Sure.
And saying, we're going to hedge it a little bit because there could be a chance that the Fed screws something up and that they have to retrace next year. And then boom, all of a sudden, and I don't think it's the beginning of the year. I think it's probably at the end. Dion, thoughts?
So I'm glad you clarified. This is something I say on my channel a lot about sometimes it's comparing someone's year 10 to someone's year 1.
100%.
About there are people who are very educated in crypto and they do great. I totally understand it. But the casual investor doesn't want to take 100% of their assets and just buy crypto.
Sure.
But if you have a net worth of $1 million and you put 10,000 into crypto, maybe.
Sure.
That's a percent.
Sure.
If you have a portfolio that's kicking off enough cash flow to pay off a debt in a few months, gamble, roll the dice. You use the terms. But that new investor with 3 or 4 rental properties, maybe 10 units if they're small multifamily, I would still be doing fixed rate debt. And it's like the people who say, should you ever invest for appreciation? No, but you will hear investors like Grant Cardone, Chris Crone, some of the people with tens of thousands of units going, I completely gambled on appreciation and here's how it paid off on this big of the portfolio way over there.
Sure.
It doesn't matter. And if I lost the money, who cares?
Exactly.
So in your situation, totally makes sense.
Yeah. I want to take the other side. Again, I have very few rules. I would not do that deal that way. I would do a 30-year fixed. If it doesn't make sense at 7%, I don't care if it makes sense at 5.25. I don't want that gamble.
Yeah.
And again, I will buy less property than you. Right.
Yep.
Because maybe that deal makes sense at 5.25. It doesn't make sense at 7.
It actually it makes sense at 7.25.
So again,
that's the fault tolerance, right? Which is that the deal is that great of a deal that it makes sense at 5.25 or 7.25. So I look at it as I'm just getting 7 years of debt.
Yeah, no, I get it. I just want people to hear me.
100%.
I am not doing that deal that way.
100%.
I will grow slower than the lumberjack because I won't do them. I get it. It's okay. I got enough. I'm only doing 30-year fixed rate. I won't even do a seller carry with a 5-year balloon. I will only do 10-year. I have lived in an environment where a balloon blew up at 5 years and it was a bad time. I want to extend. So I totally get it. It's right for you, but I want everybody to hear me. I'm not doing that deal that way, me personally.
3 investors who've reached financial freedom, 2 against 1 who still has a job.
Yeah, which one of us has a job in this picture?
Listen to full circle.
You need that W-2 to pay for that variable rate risk.
I will.
Yeah,
absolutely.
I get it.
100%. Well, I mean, the good news is I get 7 years in the 20s on return. And then I get down to what your yields are on your deals when I have to do it at 9.
Yeah, enjoy the job on Monday.
And if it adjusts to 10 in 7 years?
100%. So the key for those two is, the bigger part of the strategy you hit on it, Dion, which is the massive cash flow that my portfolio is throwing off now on 30-year fixed.
Yeah.
That's why for me, I wouldn't do this deal if it were deal number 1.
Yeah.
It's not deal number 1. It's deal number 41.
Yeah.
So our number 42 active, right? 42 active, done 70 or 80 deals, but this is deal number 42 active. So that's why I look at that deal and say, I kind of like that. But to the Jerome Powell point though, I think what I saw in that video was him tripling down, not doubling down, tripling down. We're going to get inflation. We're going to get it. We're going to keep on raising. Everybody on the board we're going to get inflation. We're going to get this thing.
Yeah. And we're not stopping early.
And we're not stopping. So just in what, in the 3-headed housing apocalypse of what I believe is going to happen, it is continuously raising those rates, continuing the inventory to build, getting people out that aren't able to, get into that next unit because they've got a 2.5 or a 2.7 mortgage. But I think that will increase the number of people going to market that do have to sell.
Well, that's the beauty is, right, once we get past this noise, because right now we're in again, I talked about it, right? July 20th, we're going to get this little proof of inventory, wish pricing, all this stuff. That's almost over. It'll probably be over by the middle of September. And then what's left, there are motivated sellers in there. Go find them.
Right.
That's why I am so excited.
So here's where I believe, and then this is the last piece, which is, I think it was what's going to come into this, is it's going to be, I think that next year that below the median house increases in price, but I think that there is so much that is not going to be the move up buyer and the luxury. I think still that median price comes down next year, because I believe the way it's going to happen is they're going to do, so the first two phases are done. They're going to eventually jump in and try and do a giveaway program. And that will drive prices below the median, which I think will pull the median price further down, because the big stuff, move up buyer stuff, won't be selling. The ultra luxury might not be selling when people's portfolios are down 40 and 50%. And so I still stick by, I believe that we're going to see that 10% correction, not next year, but over the next 12, 24 months, because I think that's what's going to pull that in, is median's going to come down. Dion.
10% from where we are now, or 10% from where we were last year?
10% median from peak. 10%
from peak. Oh yeah, from peak,
peak.
easy. Yeah.
Yeah.
But from year on year, I don't know that we would see 10%.
Well, no, because 8.9 is the biggest ever. But I think what's different this time over the last time it was not, last time it was a lot more area based on the different types of loans you could get, based on how saturated certain areas got, builders continuing to build. I think that's what's different this time. I think when it's rates, when it's purely rates, it's not geographical. When it's purely rates, it's everywhere.
Yeah.
So
it'll be interesting. I mean, I like the logic. I get it logically. I'm still going to take the other side. I think it will be flat,
Yeah.
Plus minus 1-2%. I'm going to call that flat. -2 to +2.
Well, because we were plus, this year we got up to 16, median price being up 16.6, right?
Year on year. Yeah.
And
I think now it's 10.2.
Now we're around 10. So when I had talked about it, I said, I think by the end of the year, I think we're in single digits. I think we're going to give a lot of it back. But next year we start. Next year it starts that. I think it starts.
I love it that we disagree. It's awesome. Yeah. I think a lot of people hope you're right. I hope you're right.
I mean, here's the thing though. The 10% is not going to make a difference with a rate that's 2.5 points higher. It's not going to make a difference on the payment.
Ding, 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 ding.
It's not going to make a difference on the payment. So when that price is going to go down and when median gets pulled down, that's great. And it's going to make everybody feel really good. In 2021, you could have bought the same exact house with a 20% less payment. And yeah, you were paying more money. But I think the real driver here is that it really only matters if it actually does crash. It only matters if we get a real crash that you waited. You're going to need to see a 30% plus crash at least. And there's certain markets I think that will happen in, but not a broad base. That's not going to be broad based in the median. Yeah.
You need a crash that big and lower rates.
Well, I think that's what will then lead to lower rates, right? Because I think that you get the crash, you start to see it crash, then rates start to come back in. But that's only if you've covered inflation, because Jerome Powell has made it very clear. It's an inflation story for him in jobs. And unless you see the jobs go from, something outrageous, 3.6% unemployment to like what Mike and I have talked about, 7, 8, 9. Unless you see a major move like that, it's going to be amazing watching this unfold. But again, it's not price of the house. That's one component of the story that we're talking about. And if rates are 1.5 points higher and the price came down 10%, you're still behind. You're still behind because 1 point is 10% of the house value. Buying power. Dion, go ahead.
Think of the person who doesn't watch content like this, that isn't an investor, that's just working, good grades, good job, climb the ladder, save for retirement. And they hear the government say, I get it. I get on that guy. I get it.
Well,
hang on. Right. That doesn't also invest. But the government says, in order to fix things, we need you corporate people to lay people off and stop giving raises. That's the narrative that's going out. We need layoffs and we need less raises. Don't pay more people more. The average person hearing their government tell their employer that the reason they're working and doing a good job is to hope to keep their job and to get a raise, being told to fix the economy, your goals need to be smashed. How does that feel?
Like, I don't want to be on that ride. So yeah, I appreciate you guys dialing with us. I thought my good buddy Jerry did a good job today, keeping it short and sweet. And I think that it's going to be really interesting to see how committed he is to taming inflation, because it is going to become more and more unpopular. And I'm telling you, I had a conversation with the oil company, because we start those conversations beginning part of August. They came back and they said, for us to feel comfortable, we would want to lock in oil at $8.
What was it last year?
$3.75.
Oh, jeez.
Mike, it's not even 8 now.
That's crazy.
It's like 5.5 or 5.
Wow.
like-
So they're really seeing a winter problem.
They are seeing a massive winter problem. Massive. I've talked to 3 different companies, because we spent about $50,000 on heating oil last year. So
Now you're about to spend 100.
exactly. Well, this is one of the things that we had to do. We know that our governor decided to double our strategic dollars around petrol, because the prices were going to double. So because he did that, I said, listen, I can't get that assistance for you, and I know that you probably can't afford it. So what we need to do is, I won't do the rent increase. I will allow for you guys to pay for your heating oil, but it's because you'll then qualify for assistance.
Yeah.
So it was working with the tenant to have the conversation, say, I'm not leaving you out in the cold. I'm not raising your rent, but recognize everything's going to be more expensive, but I'm not going to be able as a landlord to get assistance. You as a tenant can get assistance. And that's what it's there for. It's there for those tenants. So we worked with those tenants to say, we think this is the best approach. We worked with Section 8 on the same thing. We said, we're not paying for anybody's oil anymore. We're not doing it, because the upside risk is so high.
Yeah.
I told them, I said, on my Section 8 units, I could literally end up having to write a check
Yeah, exactly.
to have you in there for the wintertime. And I cannot do that. So Dion, tell everybody where they can find you, my friend.
Not in Siberia. But you can find me right here on YouTube, Dion Talk Financial Freedom, where my live streams are Tuesday afternoons, 4 p.m. Pacific.
They are. Michael?
One rental at a time. Saturday live streams, 8 o'clock. Join early. Ask questions early.
Make sure you super chat either of these guys if you want to make sure you get your question asked, because Dion's piking on this because he's retired. He's become lazy like the Pink Panther. He's only probably going to go an hour and a half now anymore. Mike only goes an hour, and now there's way more questions than there are minutes in the segment. So super chat, and it doesn't have to be a $50 super chat, although it's worth that. But $1, $2, whatever. Just make sure you get your question answered. And then me, Lumberjack Landlord, 11:30 a.m. Eastern time on Sunday. It will be normal, same bat time, same bat channel this Sunday. And we will have super chats up, and we will be doing some merch giveaways. So excited to finally be doing that. So like, subscribe, and make sure you check out the video on Dion's channel later on, because his topic that he came up with is absolutely fantastic. Thanks, guys.
Ciao.
Ciao.